All right, today we're going to pull back the curtain on the world of corporate finance. We're going to break down the three fundamental decisions that literally make or break every single business out there, from your local coffee shop all the way up to a global tech giant. At the end of the day, it all comes down to money. How you manage it, how you get it, and how you use it. Well, that's the lifeblood of any company. If you get it right, you thrive. But if you get it wrong, you might find yourself in some deep water, though hopefully not quite this literally. I mean, think about it. You see these massive companies like Tesla or Flipkart making these huge billion-dollar moves, and you have to wonder, how do they actually decide what to do with all that money? Well, you might be surprised to learn it's not some kind of dark magic. It really just boils down to a few core principles. Okay, so let's get right into it. At the absolute heart of every single financial choice a company makes, there are three simple but incredibly powerful questions. This is the framework we're going to walk through today. So here they are. First up, you've got the financing decision, right? Where does the money even come from to operate and grow? Second, the investing decision. Once you have that money, where do you put it to work to create even more value? A new factory, better tech, more people? This is the real engine of growth. And finally, the distribution decision. When you're successful and you actually make a profit, how do you share that success with the people who own the company? So what's the end game here? Why does any of this even matter? Well, it all comes down to one single overarching goal: to maximize the company's value for its owners, the shareholders. Every choice, every decision is a step towards that one peak. Okay, to make this all feel a bit more real, let's follow the journey of a brand new startup. We're going to see exactly how these decisions play out in the real world as a simple idea grows into a major company. Almost every great company you can think of started with just an idea. And yeah, usually a pretty empty bank account. So the very first stage of funding is what we call bootstrapping. This is where the founder is just digging into their own savings, maybe maxing out a few credit cards, and using whatever personal resources they can scrape together to get the dream off the ground. Now, once the idea starts to show a little bit of promise, but way before it's a proven success, the founder might go looking for angel investors. These are usually wealthy individuals who invest their own cash in these early-stage companies in exchange for a piece of the ownership. They're planting what we call seed capital to help the business really start to grow. And just look at the numbers here for a second. The founder or promoter still has the biggest piece of the pie at 40%, but to get that all-important seed money, they've had to give up 10% of their company. This is the classic startup dilemma, right? You absolutely need cash to grow, but every dollar you take costs you a little piece of your own company. All right, let's fast forward a bit. The company's growing, it's starting to prove its business model works, and now it needs some serious fuel to expand. This is where venture capital firms, or VCs, step in. They invest much, much larger sums of money to fund those critical investments needed to scale up in a big way. Now, this table is super important because it shows us something called dilution. See, the founder and the early angels haven't sold any of their shares, but because the company created brand new ones for the VC, their slice of the total pie just got smaller. The whole company is worth a lot more now, for sure, but the original owners have a bit less control. Okay, our little startup is all grown up now. It's a mature company. And that means the funding game totally changes. It's not just about selling off pieces of the company anymore. Now it's time for a really big decision. Do you take on debt or do you sell more equity? This is the classic showdown. With debt, you're essentially taking out a loan. You have to pay it back with interest, and those lenders have first dibs on your cash if things go south. The upside? They don't get any control. With equity, you're selling another slice of ownership. These investors get a piece of the profits forever, and they get a say in how you run things. But they only get paid after all the debts are settled. So why on earth would anyone take on debt? It all comes down to this powerful idea called financial leverage. Think of it like a seesaw. If you use debt in a smart way, you can amplify your profits and lift them much, much higher for your shareholders. But, and this is a big but, you have to be careful. If things go wrong, that same debt can bring you crashing down just as fast. So what's the right move? Honestly, there's no single magic formula. The best companies find what's called a capital structure. That sweet spot, a mix of debt and equity that fuels their growth without taking on a crazy amount of risk. It is a true balancing act, and the company's future is literally on the line. And we did it! Our startup made it through. It's successful, it's profitable. So now we get to the third and final decision. What do we do with all that cash? It's time to talk about sharing the profits. Basically, you've got three main choices on the table. One, you can reinvest the profits, which is really another big investing decision, to fuel even more growth from the inside. Two, you can pay that cash directly out to your shareholders in the form of dividends. Or three, you can use the cash to buy back the company's own shares from the open market. Now, if a company decides to pay dividends, it's got a choice to make. A cash dividend is exactly what it sounds like. You get a check. But a stock dividend is different. It's like instead of giving you a slice of the company's cake, they give you a bigger plate, so your potential piece of the cake is larger in the future. The cake itself doesn't get any bigger at that moment, but your potential to enjoy it sure does. You know, dividends and buybacks are way more than just ways to return cash to investors. They're signals. They send a message to the entire market. Paying a steady dividend says, hey, we're stable, we're confident. A buyback, on the other hand, often says, we think our own stock is a bargain right now. Each choice tells a different story about where the company sees itself going. And for so many of these startups, this right here is the top of the mountain, the ultimate goal, the IPO, the initial public offering. It's a huge fundraising event, sure, but it's also a chance for the founders and all those early investors to celebrate an incredible journey, from a simple idea to a public company. So after all that, debt, equity, dividends, buybacks, what is the best path for a business? Well, the truth is there is no single right answer. Every single financial decision is a delicate balance between risk and reward, between growth and control. And the only constant in that whole equation is the goal, to build a company that's truly built to last.